Hey everyone, in this video we are going to walk through the homework for chapter 4. So let's begin. Okay, on question 1, we have a number of transactions here listed, and we're going to need to analyze the transaction and identify which accounts are impacted, and what category they are, and whether it's an increase or decrease, and a debit or credit, basically. So one thing in the instructions here. So we're going to list the balance sheet accounts first. So remember, balance sheet accounts will be our assets and liabilities and equity, and our income statement accounts will be, revenues and expenses. And then if both balance sheet accounts are balance sheets, list them in the order they appear. For example, if we have cash, then cash is going to be the most liquid account. So we'll put that first for assets. So with that said, let's begin looking at the transaction. So our first one is done for us. It tells us that we sold a 1-month membership to customers for $4,500. And we've got an accounts on account is the important verbiage there. So it's not, they didn't pay us cash yet. So we have accounts receivable, and that is an asset. We've got revenue associated with that sell, this transaction, and that's a revenue account, both increasing. And accounts receivable as an asset increases with a debit, and service revenue, revenue of all types, increases with a credit. Okay, so on June 3rd, we received a telephone bill for $250, which will be paid next month. And so in this transaction, we're going to identify one important thing is that it's going to be paid next month. So it's not a cash transaction, but instead it's an accounts payable because we're going to pay it next month. Accounts payable is a liability. Accounts payable is going to be increasing as we owe this amount now. And to increase a liability account, it's a credit. And then on the other side, we're going to record an expense. So this is a telephone. Let's see if we have a telephone expense here. It's an expense, kind of obvious, it's in the title of the name. That's going to increase as well, right? We're recording our expense for the month for that. And to increase an expense is a debit. Okay, June 6th, we paid an employee's salary of $1,200. So this one we do have cash transacting because we're saying that we actually paid it now, currently, as opposed to paid in the future. So we're going to decrease our cash, and to decrease cash, it is a credit. And then we are going to recognize salary expense, and similar to the transaction above, it's an expense. We're increasing that expense, and that's going to be listed out with a debit. Okay, on June 10th, we received $3,000 cash from customers paying in advance for upcoming 1-year memberships. So the key thing here to identify is that they're paying in advance. So we haven't earned this money yet. We've received the cash but haven't earned it. So that's an unearned revenue. So step 1, let's record our cash that we received. So we got the cash that's increased, our cash increased, which is a debit, and it's an asset. And then unearned revenue is here. It's a liability account because we have this cash, but we haven't yet earned it. And so we're going to increase our liability for unearned revenue with a credit. June 15th, we paid $6,000 cash in advance for 6 months of rent. So again, we paid the cash. That's an asset. We're going to decrease that asset with a credit. And it was prepaid rent. We're paying for how much? 6 months of rent here. So that is also an asset. So we're going to decrease our cash asset and instead increase our prepaid rent asset. And to increase an asset, it is a debit. Okay, June 20th, we received a $10,000 loan from the bank. And so we got that cash, which is an asset. We increased our cash with a debit. And then along with that cash that we got, we now have a related bank loan. Let's find the account that goes along with that. Notes payable. Sometimes you'll see bank loan listed as an account, but notes payable is typically the liability account that would account for any kind of long-term debt. So as opposed to accounts payable, which is more short-term operating type liabilities that are paid in the normal course of business, the notes payable is a liability that indicates more of a, like I said, a note that goes along with it. So it's a long-term payment, essentially, like a mortgage or some other type of long-term financing. And we are increasing that liability. I had that wrong. Okay, increase liability, increase the liability with a credit. And finally, we purchased equipment worth $8,000 cash. So we want to increase our equipment. Equipment is an asset. Increase it and increase it with a debit, just like any other asset, like cash or anything else. And then kind of the opposite here, we're paying, cash is an asset, and we're decreasing our cash to account for the fact that we are paying for the equipment with cash. Oh, what did I miss here? Asset increase. Oh, sorry. They wanted the most liquid asset first. So let's put cash as the first item. Okay. Yeah, just a matter of organizing the assets and liabilities correctly there. So, okay, now we've got 100% on this problem. Let's go on to the next question. Okay, for the following list of accounts, indicate which side of the T account causes an increase or a decrease. And the first account has been done for you. So cash, increase with a debit, decrease with a credit. So expenses have the same increase, decrease as assets do. So increase with a debit, decrease with a credit. Service revenue has the opposite of an expense, essentially, if you want to think of it that way. So a debit will decrease and a credit will increase. Unearned revenue is a liability, so it has the opposite of an asset, essentially. So credit increase. Accounts receivable is an asset, so it will, just like cash, increase with a debit. Accounts payable is the opposite of, as a liability. It's the opposite side of the equation as cash and the asset there. So that will be adjusted accordingly with the increase with the credit. Owner's capital is on the same side of the equation as liabilities, and so it is also increased and decreased. Decrease with a debit, increase with a credit. Owner's withdrawals, which decreases capital, kind of has the opposite effect there. So we're going to decrease with a, let me make sure I got this right. Decrease with, yeah, that one's a little confusing because we're going to increase the withdrawals with the debit, and we're going to decrease, which decreases capital. So it's kind of similar to an expense. That's probably the easiest way to think of it, like an expense, essentially, as it has the same impact of debits and credits. Prepaid rent is an asset, and so we increase with the debit, decrease with the credit. And then again, every expense account follows the same pathway. Oh, what did I do? Rent expense. Oh, I have that backwards. Yeah, so as I mentioned, every expense account, just like we have here, increases with the debit, decrease with the credit. And that's 100% there. Okay, let's go on to the next problem. All right, everyone, we are on to question number 3 here on the homework for chapter 4. And in this question, we are required to do a number of different journal entries. And we've got the transactions listed out here above. I'm going to take a quick screenshot snip of the transactions so I can scroll down a little easier and focus on the journal entries here. So our first transaction says December 1st, we received a travel bill for $430, which will be paid next month. So the key things there is that it will be paid next month. And so we can identify that this is going to be a liability, an amount that we owe, and that liability will be accounts payable. And we're talking about travel, so we're going to want to put our debits first. And an expense increase is a debit, and then our liability increase is a credit. Okay, transaction number 2, we received $2,690 cash for training services this week. So we received the cash, it says there. So cash will be our asset, and then revenue will be the other side of the entry there with a credit. So increasing revenue. Third transaction, we borrowed $7,000 cash from the bank. So let's see if we've got notes payable, a bank loan. Here we go, notes payable. Okay, and we've got $7,000 there. So cash going up $7,000, and our liability going up $7,000 concurrently. Okay, we received $430 from a customer who owed money on services already provided. So we got the cash, and the fact that it notes that we already provided these services would indicate that we have already billed them for it. And so we are receiving the cash, and we would have originally recorded the revenue with an accounts receivable debit and a credit to revenue. And now we're receiving the cash to basically eliminate the receivable and just complete the transaction essentially. So on December 9th, we prepaid $1,680 for rent for 1 year. So we have a prepaid asset going up, so prepaid rent, and we're paying for that asset, exchanging our cash for a different asset in this instance. And that gets us 1 year of rent. And then remember, every time a month would go by, we need to reduce this by 1/12 because it's a year, and record 1/12 of this amount as an expense for rent because that month has elapsed. Okay, we paid the telephone expense of $100 for the month with cash. $100. So we're reducing cash and increasing our expense. We paid $660 to reduce the amount owed to a supplier. So in this one, we're going to debit accounts payable to reduce it, and then credit cash to reduce that as well. And then December 25th, we paid $33 interest on the bank loan. So we're going to say interest expense here. And it says, yeah, we paid it, it's a cash transaction. And that should be all of the marks there, 50.50 out of 0.50, so 100%. Okay, and we're on to the next problem. Okay, question number 4. Very similar problem here, it looks like. So again, I'm going to snip the transactions. Okay, and we're going to go through and do the journal entry. So on August 1st, we provided services to a customer on account. So remember, the fact that we're saying on account means that we're going to receive the cash later. So we have accounts receivable. Then we have service revenue as an offset to record the fact, to account for the fact that we are, we performed the services, we are owed that money now, we've earned that revenue in this period, we just haven't received the cash yet. Okay, we borrowed $6,000 cash from the bank, so we got cash, and let's find our notes payable. So our asset of cash goes up, and our liability of notes payable goes up as well. August 6th, provided customer services and received $3,033.40 in cash. And service revenue. So just, to quickly contrast this account, we provided the services and they're going to pay us later versus we provided the services, they're paying us now. And you still record the revenue at the same time. The only difference is you have an accounts receivable and you're going to receive the cash later in this transaction. And once you receive the cash, then the accounts receivable will be credited to go to 0 and the cash will be recorded as an increase. Okay, August 8th, we got a travel bill for $140. So travel expense, and it'll be paid later, it says. So in accounts payable, August 9th, we paid $85.70 cash to reduce the amount owed to a supplier. So accounts payable is going to be going down, and cash will be going down. So a liability decrease and a cash and asset decrease with cash. August 12th, we collected $1,930 cash from customers that owe us on account. So cash is going to go up, and accounts receivable will go down, because this is kind of the sort of the second portion of like this transaction here. So first you would record revenue and a receivable, and then once you record actual cash later when you're being paid, then you record the increase in cash with a debit and decrease in accounts receivable with a credit. Okay, August 13th, paid the travel bill from August 8th, so $140. So again, with the payable side, we're going to debit the payable now. Where are we at here? Accounts payable. Was that this one? Oh, it's this one here. Okay, sorry. So $140. So first we credited the payable to increase it. Now we're debiting it to get it to go to zero, to decrease it. And we're decreasing it by paying it, right? So that we don't owe that money anymore. August 16th, we paid a portion of the bank loan principal with $1,600 cash. So similar with accounts, the accounts payable or notes payable, they're both liabilities. They both decrease with a debit. Just different types of liabilities. This one being more long-term, accounts payable being more short-term. To record salaries for the months, we paid $3,000 cash. And we've got salaries expense. And finally, we purchased cash for $2,060, which will be paid later. So we're going to go, let's use accounts payable. I'm assuming that's the right account. Sometimes when you purchase equipment, it might be a more long-term contract, financing contract. Maybe you're buying it just like you would with a car or something else over 5 years. And in that case, it wouldn't be accounts payable. It would be more of a notes payable type situation. But let's hit check and just see. Okay, accounts payable is the right account in this instance then. So usually, one thing to just kind of keep in mind, this isn't a hard and fast rule, but notes payable typically are larger amounts too. So if it was a vehicle for $30,000 and you financed it, you would probably have a notes payable, not an accounts payable liability being hit. So just something to keep in mind. That's more of like a real world type situation. I don't think you'll see that kind of delineation need to be made on a homework problem or a test problem, but just something to keep in mind, how to sort of delineate those two things in your mind, accounts payable and notes payable. Okay, so we have this company. These are their closing balance in July and a chart of accounts. And I'm going to snip that because I'm sure I'm going to need this information. Okay. And so we need to go through and do a bunch of stuff. So first thing we want to do is just put our posting reference, or kind of another way to think that's our account numbers. So cash is account number 101. Capital is 300. You can see here, it's kind of, this is our menu or chart of accounts. 101. Unearned revenue is 210. Insurance expense is 515. Accounts payables 200. And this is all just coming directly off our chart of accounts. Just picking from the menu basically. 520, 101, 105, and service revenue is 400. Sure, it didn't want anything different on those, but I believe that's what the problem was asking for. Yep, so we've got all those transactions. These are all the journal entries recorded, the accounts and the account numbers, the account names here, the account numbers, and again, that's all captured in the chart of accounts. And now we're going to go through and post these journal entries to our ledger. So let me snip the journal entries actually and have those on my second screen while we go through. Okay, so for cash, first, actually there's a few things we need. We need our opening balances first of all. So let's go through and put in opening balances. So 8,600, and cash always has, assets always have debit normal balances. Accounts receivable 6,200. Again, a debit. It's an asset as well. Prepaid insurance 1,700. Oh, that's not the. There we go. And again, debit balance, equipment 38,100. Same debits, normal balances for all the assets. Now we have liabilities. Accounts payable, so 7,600. And now we're doing liabilities have a credit normal balance. You know, they increase on the credit side. They start with a credit balance unless they're negative for some, reason, a mistake or something happens. But should have a credit balance typically. Unearned revenue 4,000. We should have looked at the notes payable balance is 20,100. Okay, getting close. Capital has a 22,900 balance. Capital. And that also, it's on the same side as the accounting equation, assets equal liabilities plus equity. So it's one kind of hint, if you will, that, indicates that equity or capital is going to have a credit normal balance, just like liabilities would. Okay, now let's go through and put our journal entries activity, post those to the general ledger. So for transaction 1, we have, and I'm just going off here, we have increase in cash, and so we have an investment being made here, a contribution into the business. So we're going to debit cash and credit capital for 7,000. I also need, I'm going to pull this is where Excel comes in handy, or different computer softwares, because when you're doing a general ledger, it's a running total. And so you want to take your 8,600, and since we're debiting, we're going to add those together. If this was a credit, we would decrease, from that. So we say 8,600 plus 7,000. Okay, and that's the debit side of the end of the journal entry. And then we want the credit side, we're going to go down to capital, and same thing, 7,000. And since this account has a credit normal balance, that means it increases on the credit side. And so if we take 22,900, we get 29,900. Adding these two together, credit plus a credit, gets us there, as opposed to debit plus a debit for cash, because assets have a debit normal balance. Okay, let's see here. Let's go to our next journal entry. Okay, the second journal entry on the 8th is receipt of cash, and this is unearned revenue. And if we take 15,600 plus 1370, we get 16,970, and that's debit balance. And the other side of that entry is the unearned revenue liability. So we're gonna, I can do the math on this one. We're gonna increase that. I'm not sure. I think I'm gonna leave this out for now and see. I don't think we need to have a running balance in each column, but we may need to drop this down to show that at August 2nd there was no activity, but there was a balance that carried through to the 5370. I'm not 100% sure on that. So let's put all these. I'm not sure how the computer grade, the software here grades whether you have to have amounts in every single box. So let's leave it the way it is for now, and we'll come back and check when we do our check button. Okay, on the 11th, we had accounts payable being increased with a credit. And we're going to increase that by 720. Let's do the math here. Okay, 7, 8. Oh man, no, that's not right. I should be able to do this math in my head, but sometimes it's better to make sure you're doing it right. Okay, credit balance plus a credit. And then the expense side is insurance expense. So let's find our insurance expense. That was a debit on the 11th. So our running balance was basically 0 up until we posted that entry. Now it's 720. I think I got both sides of that transaction, the credit and the debit. Okay, August 15th, we have interest expense of 110. Be careful not to mix up the account number with the actual transaction amount, because interest expense is account 520. So don't put 5. That's just a number that is like a name, like your social security number. It's just a reference number for that account. So be careful not to mix up. Don't put 520 here. That's just the number of the account. But sometimes they're right next to each other. You can get kind of confused on that. So just something to watch for. And finally, we have accounts receivable being increased on the, what day is this? The 20th. So we want to debit our accounts receivable for 2040. Okay, I think I can do this math. 8240. It's a debit balance. And so again, asset, normal balance to start, it's a debit. We're going to debiting a debit and adds to it. And we get 8240 to end. And then the final transaction here, service revenue is a credit. Let's find our service revenue account on the 20th, 2040. The balance just carries through, and then it's a credit balance. And let's see how our score comes out. Like I said, I'm not 100% certain if I need to maybe carry down some of the amounts. Yeah, I'm missing. I'm just going through now to make sure I didn't. Let's try this. Because technically these aren't transactions that occurred. There's no transactions that occurred on those days, but when you have an opening balance, technically when you look in a GL, you would see that balance carries down until the next transaction, and then it updates. So that might be the source of my non-perfect score. Let's check. Nope. Still the same. Okay, no, it doesn't like that. Okay, so let's back those off then. So specifically, we don't need to carry anything down. Those actually give me the red X's. So what am I missing otherwise? Let me take a second look back through, make sure I've got, did I get capital in there? Oh, maybe I missed a transaction. Okay, bear with me for one moment. So this is kind of good practice just to sort of, make sure you didn't miss anything. So what I'm going to do first is I'm going to snip find my snip tool, the little screenshot snip of the beginning balances to make sure I put those all in correctly and I'm not missing anything there. Because we know these are all right. Our beginning balance here, 8,600 cash. Yeah, it's got the green arrow or the green check mark. That means we're good. I just want to make sure I didn't miss one or something. Yeah, and then revenues and expenses never have beginning balances. So what am I missing? Nothing from the beginning balances. Let me look back through. Now I'm going to check my my journal entries one by one and make sure I got all those in right. So August 2nd, we had, that's the 7,000, and we had capital 7,000. So that, oh, here we go. One little thing. Make sure I didn't do that somewhere else too. You gotta be sure anywhere that there's a running total and an updated balance that you have to have the indication of debit or credit as the ending balance there. So that got us to 0.95. Geez, what am I missing otherwise? Probably some real little dinky thing. It's kind of and just to, no, that's not, yeah, that's not going to be a change. Okay, well, let's keep looking. So that was the 7,000. Transaction number 2 was the 1,370, and it was the other side was the unearned revenue of 1,370. So we've got our credit, we've got an updated balance, we've got credit indicated, so that looks good. We have insurance expense, 720. Yep, and we've got all those marked there. Okay. Then we've got the interest expense on the 15th. So we've got 110 to the debit. And that all looks good. And we've got cash as a decrease. Oh, I'm missing the cash decrease there. Okay. So yeah, like I said, that's the process, is just go piece by piece until you realize, you see like, oh, there's the one piece of the journal entry that I missed. So 16,970 minus 110 gives us 16,860. Still a debit balance, debit ending balance. So again, we're taking a debit beginning, running balance, I'll say a running total, and then when we credit that, that's going to decrease that amount. So a debit being credited decreases the overall total, and we end up with 16,860. Let's click check, cross our fingers. Woohoo! Okay, we got them all in there. So that's a good little lesson in how to kind of like go back through and self-check and self-review and self-check is extremely important as an accountant. It's one of the most important skills that you can develop, honestly. So that is not time wasted learning how to do that kind of process. So, all right, let's go on to question number 6. Okay, in question number 6 here, we have this company. We've got a bunch of accounts with their normal balances. And I think what they're kind of trying to play out here with this is that they're not in order necessarily. They're not organized. And so we, as our budding accountants, we're learning all of our skills here, can practice those skills by going through and kind of organizing this information and using this information in putting a trial balance together, basically. So that's what, kind of a trial balance is, sort of just like that organization of the accounts, essentially. Let's check myself. I make sure I don't mix up the order of the names and stuff. So for these reports, so okay, and this is pretty easy because it does give us. So now here is a more organized trial balance version. You've got assets here, account liabilities here, equity accounts here, service revenue, and then expenses. So that's that's how trial balances and general ledgers, etc., are usually organized kind of in that fashion. A chart of accounts, all those things with assets first, liabilities, equity, revenue, and then expenses. So anyway, let's go through and just put all of our totals in. This is pretty easy work. We're just going through the list of accounts, and we need to know whether they're a debit or credit balance, I guess, is one of the key things here. So all of our assets are debit normal balances. All the liabilities are credit normal balances. And then our capital is also a credit normal balance. Our withdrawals have a debit normal balance similar to expenses. That's I don't know. I always think of that. That helps me remember. Where's our revenue? Service revenue 9680. Insurance expense 1640. Rent expense 2950. Salaries expense 5070. So I'm just going through this listing. I had, like I said, I snipped it to the side, so you might have to scroll up and down. Okay. And then our final kind of check figure, we need to go through and summarize everything at all the totals here to make sure all of our debits equal our credits. That's one of the check figures that is inherently built into this report. And again, like I said just previously, check figures and making sure you're remaining in balance is probably, it's definitely one of the most important aspects of accounting in general. So I did my math, I added all of these up, and the debits and credits come out to $54,990. And we got our 100%. Okay, we're on to the next problem. Excuse me. Okay, this looks very similar. Okay, so let's put the name of the company and the name of the report. This is our trial balance. Let's put our date in there. And just to I don't know, do this, I'm gonna just copy and paste these in. So I'm just double clicking and Control C and Control V. I think that might be a little quicker than snipping and doing all that stuff. Really just organizing everything. These are all of our assets. So a reminder, this is kind of the core concept here in this chapter. All assets with a debit balance. All liabilities with a credit. Let's see, capital. No withdrawals in this problem. I think there was in the last one. Revenue is a credit. And rent expense. Salaries expense. If I can find it. There it is. Depreciation expense. And yeah, good to go. Okay, I'm just going to add these up here. Get 103,520 for debits. Let's add up all our credits and make sure that is the same. Unless I added something wrong. I got 106. 13,5, 824, 9,400, 430, and again, this is part of the the check figure part. Sometimes it comes out where your totals don't balance, and so that's where you have to go back through and add everything together. Let me just double check my math. That all looks good. Maybe I'm missing one. 2730. Cash. Oh, I put capital. Yep, that was my mistake. I saw the C and I just threw it in there. You guys probably saw that as I was doing it. So let's try 14,160. There we go. Now I get 106,250. So I had accidentally input the total for the balance for capital in place of cash. So once I fix that, we should be good. Our check figures total, and something to keep in mind. This is a check figure to make sure all your debits and credits balance. But you could definitely still if you posted an entry twice, you would two entries, four debits and credits. Let's say for one entry has a debit and a credit. If you accidentally book that entry twice, then you would still be in balance. You wouldn't be able to catch that you made a mistake, but you could make a mistake. So don't take that's a common question on exams and quizzes and homework maybe and things like that is just because this balances, that is a check figure to make sure all your debits and credits you didn't do any one-sided entries or unbalanced entries, but it's not going to tell you that you might have not made a duplicate error or posted to the wrong account. That could happen too. Like you could mean to have recorded salary expense, but you accidentally put it to rent expense. Rent expense would just be higher, salary expense would be lower. You would still balance, but you would have errors in your accounting. So just something to keep in mind. Okay, question number 8. Okay, in this problem, we have a part-time bookkeeper, and we've created this trial balance at the end of the year. Can't get it to balance. The entries have been journalized and posted properly, and all the accounts should have normal balances. So I think I can see right off the bat what this one problem wants us to do is to look at this trial balance and kind of see that, oh, hey, wait a minute. Accounts payable should have a credit normal balance. Accounts receivable should have a debit normal balance. So we just have to kind of fix the problems in this that we see here. So just a way to help us practice. So remember, accounts payable has a credit normal balance. Accounts receivable has a debit normal balance. And and that's about it. I'm going to let you guys, I'm not going to do all this work for you because it's kind of just tedious on my part. And also I want you to actually have to sort of go through and do some thinking, not just completely follow along in the video for this one. So that's the process. I'll leave you to the rest of that problem and then total them up. Okay, indicate whether increases and decreases correspond to debits or credits. And so I'll do probably, the first one. So this is, again, pretty easy work. And so if you go back to your debit and credit reference chart or the book, etc., so very core, important skill to have. And there's some mnemonic devices we'll talk about in class, some other methods that kind of help yourself memorize, but that is one thing that would be helpful to memorize, at least, from the perspective of assets, liabilities. I think revenues and expenses and just overall equity, kind of understanding that. Important to know what increases or decreases with the debit or credit. Okay, let's go on to the next problem. And again, I'll leave you to finish that rest of that problem there, but just do that first part to talk about it, get you started. Okay, on January 21st, 2024, the bookkeeper discovered an error in the journal entries, and we had the booking. Let's see what happened. Okay, on January 3rd, we purchased office furniture on account for $1,660. However, it was recorded in the journal of ledgers for $16,660. So step one of fixing an error in journal entries, because that can happen, is to reverse the original incorrect error. And so we bought it on account, so there's a payable, some sort of liability associated with it, and it was office furniture, so it was an asset. So my mind, I just go directly to reduce our asset for $16,600. So that's going to reverse this original incorrect entry. We're going to debit our accounts payable for the same amount. And so by doing this, this is reversing that. The original entry would have been to debit the furniture and credit the accounts payable for this incorrect amount. So we're just flipping that basically and saying, okay, credit the office furniture, debit the accounts payable, reverse it. And now let's go back through and rebook it. So this is similar to what the original transaction would have been, but with the right amount in there now. Oop, okay, and now you get 100%. So that takes us to the, question 11. Oh, I thought there was only 10 questions. It's funny. Okay, let's finish one more. Actually, I think I'll let you guys work on this one. So, this is extremely similar to the last problem we just had. So what you want to do is reverse that original incorrect entry and then book your entry to, in this instance, what we're going to be doing, instead of debiting office supplies expense, we debited equipment. So you're going to want to reverse that original entry, which debited equipment. So you're going to want to credit equipment, and you're going to want to then book the entry in, which is going to debit, I want to say, office supplies expense instead of the asset of equipment. So I'll leave you to that. Good luck finishing there. If you guys have any questions, feel free to reach out to me. And yeah, look back at the problem for this if you need kind of an example too, of just the logic there. So thanks, everybody. Talk to you soon.